I'm Neetha Bidway, and this is Good Revenue. And I'm laughing because when we recorded our last episode, I was under the impression I was almost recovered from an illness. And as it turns out, in 2025, in this particular timeline, if you get sick, you will be sick for ages. So still working my way through something. Bear with me on the voice. Hopefully it'll be back to normal by next week. For today's episode, we have updates on China's latest retaliation against the United States over the matter of Taiwan. We also have mixed market signals as we wrap up the year, which is going to give us a lot to think about for 2026. We'll get into a story that is really fascinating about Salesforce saying the quiet part out loud. AI compute race updates at the close of 2025. And finally, why energy is likely the growth jobs sector for 2026. If you're new, hit the subscribe button. And if you're looking for any reports or links to anything we talk about, you'll always find that in our show notes. Let's jump right in. China is escalating sanctions against the United States, specifically 20 defense firms, as well as 10 specific executives. And we have to just say from the start, this is entirely expected. This precarious, highly volatile relationship between the United States and China seems to have no sign of actually calming down. I think it's likely moved from the immediate rational relationship to something else over the course of 2025. Hopefully, at some point in the future, cooler minds will prevail, but that's not where we are today. The United States approved a new $10 billion arms deal for the defense and protection of Taiwan this month. And the government of China has just responded by sanctioning 20 US defense firms as well as 10 individual executives. The firms include Northrop Grumman, L3 Harris, and an arm of Boeing, which is focused on defense. Anduril, which is one of the American startups that has been very successful in securing a number of defense contracts, they and their CEO have also been sanctioned. And what this means is that the individuals are banned from entry into China, and assets in country have also been frozen. Now, this is one issue, but I think it is part of a wider trend that we have been discussing for months now. And that is the fact that the core relationship between the United States and China is precarious, to say the least. It is on tenterhooks over a host of different issues, ranging from Taiwan to defense and security in general, AI chips in particular, and the massive issues having to do with trade, tariffs, and supply chains. And there has been nothing but chaos, turmoil, and on again, off again in 2025. So as we close out the year and we look towards 2026, the thing I'm really struck by is the fact that there appears to be no real sense of how a long term truce can possibly hold with stakeholders that really have not addressed any of their underlying differences. So this is the latest round in this fight. And I think we can very clearly expect more disagreement and very strong differences of opinion all through 2026 at the rate we are currently going. As we get close to the end of the year, markets are dealing with a number of different interesting trends. The stock market remains at record highs as we record this, but there are continuing signs that all may not be well just below the surface. There were three stories in particular that caught my eye that I think speak to this. And the first has to do with private equity and the extreme reliance on continuation vehicles in the past couple of years. And here's some of the data. Continuation funds grew from $35 billion in 2019 to over $100 billion in 2025. And we did a couple deep dives over the year. We'll link to one of those, which might be helpful if you want to get a larger sense of the depth of this as a vehicle. And what's really interesting is that private equity firms continue to hold 31,000 companies. And their core challenge is that interest rates have been so high that they've been unable to exit from these firms, and therefore the ownership assets have been transferred through continuation vehicles. Now, this has been good for some companies for which a longer hold period actually makes sense. But critics are also noting that it is a way of circular financing having a through line through private equity as well. And it's causing potentially some issues that may never get resolved and are putting a lot of pressure on older LPs, meaning earlier money in some of these deals. It's a very interesting article in the New York Times. Recommend taking a look at this if you've been thinking about CVs or private equity in general. The second story, which ties into this too, the borrowing rates really have driven so much of deal making this year and in the last couple years, certainly coming out of the pandemic. And the borrowing rates for AI firms is another one of those harbingers of doom that I think we might look back at in the rear view mirror in a couple of years. And this second piece, also from the New York Times, talks about the fact that AI infrastructure companies raised more than $100 billion dollars in this year, a ton of money, and that their debt costs are really dwarfing that in a way that maybe we don't fully appreciate because stocks have been doing so well, particularly for the Mag 7. The debt costs range from 7.75% for companies like Wolf Compute to 9% for CoreWeave. Applied Digital was actually paying 3.75 points more than its peers. And all of this is because they have to raise money to keep everything going. But interest rates have been so high that there's been a lot of concern on the part of investors about whether or not this infrastructure debt is really going to make sense. And there's a lot of nuance here, but I think that the investors in the debt markets seem to be a lot more circumspect and maybe more astute. History will tell if that was right or not, but it certainly seems to be from this data. Now, the third data point, we are in a moment when central banks are finally cutting rates. 9 of 10 central banks, including the Federal Reserve, the European Central Bank, and the Bank of England, have all been making significant rate cuts. In fact, the rate at which they are cutting hasn't been seen basically since the financial crisis. So there's another note to keep in mind. And the only notable exception has been the Bank of Japan, which instead of cutting rates, has raised rates twice. So that's a separate challenge because Japan has obviously been a more insular banking community for decades now and has a different set of challenges associated with that. But the trend here is interesting because even as interest rates come down, the Fed and other economies around the world are struggling and doing their best to try to make sure that we don't end up with stagflation. And at the same time, even if interest rates come down, that alone is not going to solve the core problem of whether or not the valuations on those continuation vehicles and those private equity deals, as well as startup deals on the VC side, are all of those real? And are those actually the numbers that future investors, either in private or public markets, are really going to pay for the underlying assets? I'm a little skeptical. Again, remains to be seen where this shakes out in 2026. AI has been the other topic. I think it's been neck and neck between tariffs and AI in terms of topics we've covered and been focused on in 2025, as I'm sure you have been too. Salesforce has just said the quiet part out loud in a really interesting piece in the information. Specifically, they note that the unreliability of accuracy in large language models just can't be ignored. And they've seen this because in 2025, they really doubled down on their Agentforce product. And they realized that it was really too expensive and labor intensive for them to be using LLMs in the way they had hoped to effectuate the results that their enterprise clients expect and demand when it comes to Agentforce. So Salesforce has basically reworked Agentforce away from LLMs and into more of a traditional automation So something more deterministic, but also not really what AI has been sold to us as over the past couple years. The issue here is that the random outputs that LLMs deliver just couldn't be controlled. And I don't think this is entirely surprising. As we've talked about in other episodes, the rate of hallucinations in particular and the challenges with achieving anywhere near even 90% accuracy for most LLMs has been a huge blocker. We did a deep dive in November, which we'll also link to if you want some of the data on the top models as of that recording. So it's about a month old. But it gives you a sense of the real trade off of accuracy versus hallucinations has just been a problem that no one has been able to solve as we close out 2025. And the last point is that Salesforce found that there was a lot of extra cost to monitoring and the guardrails that they had to put in place when they were using LLMs within Agentforce. And all of that meant that ultimately it just wasn't worth it. And so they've backed away from that. Now, that's just one case study from a company that has obviously had a very successful enterprise business for a long time. They've actually been adding customers this year to Agentforce. So the business actually does seem to be going quite well for Salesforce. And we'll link to that too. But it is a really interesting question, again, for all of those products out there that are LLM dependent and are also struggling with accuracy. What's the plan? So LLMs might be in a precarious spot, but as we talked about in that November episode, the top firms are all seemingly also exploring hybrid AI and world models. So clearly they're aware of some of these challenges too, and are seemingly thinking of what they need to invest in next. But one thing that they're all very committed to still is AI infrastructure. Specifically, Alphabet. Alphabet at the end of 2025 has invested $93 billion in compute. That's almost double their investment in 2024, just a massive amount of money. This is focused on data centers and GPUs. And again, we talked about this in the AI episode, but the challenges here are the AI infrastructure costs, the energy costs that go into this, and the cost of chips. Not only are these chips fabulously expensive, whether Google is building their own, that's the TPU, or if they are going to still buy some from NVIDIA, the GPUs. Regardless, it's a massive cost. And there is a problem of AI chips burning out really quickly, which is also causing issues from a depreciation perspective. So it's just a massive ongoing investment that these firms have to make to keep this all going. And Google has spent a ton of money in 2025 to do just that. In addition, Microsoft spent over $70 billion on AI infrastructure and grid expansion. And Amazon, their CapEx was about $85 billion for new data centers and their custom chips. Those are the Trainium chips. So these are massive amounts of money. The combined infrastructure cost for just these three firms is $250 billion. And it doesn't seem like there's any end in sight or really a clear sense of where any efficiencies in expenditure might come in 2026. Now, that doesn't mean that it won't happen, but right now it looks like the commitments are extreme and are expected to continue for a very long time. In our last story, there is a global energy jobs boom, which is actually very positive and exciting that we wanted to talk about. The global energy workforce has reached 76 million people in 2024. That's up 5 million jobs since 2019. So a lot of growth. The annual growth rate averaged nearly 2.2%, and that is double the overall global rate. And out of energy, the sector that has had the most jobs has been the power sector. And that is probably not a big surprise to you if you've been tracking AI data centers and the massive demand for energy that is dominating certainly our needs here in the United States, but also in China and in other countries around the world too, seeing huge growth in that sector. The growth is coming from solar, from nuclear, from the energy grid broadly, and also from battery manufacturing. And the constraint on this right now is the fact that we don't have enough skilled labor globally to meet this demand. So it's an interesting and exciting opportunity for folks looking for new fields or wanting to build additional skill sets, I think, because it looks like there's a lot of opportunity coming to this sector as we move into 2026. And with that, that's all we have for you today. Thank you so much again for joining us. We'll see you back here very soon. And if you haven't already, hit the subscribe button.
Thanks for listening. If you liked what you heard, leave us a review, subscribe to the show, or check out another episode. We appreciate your support.